Welcome to Longview Conversations with. This is the 11th installment in our podcast series where we talk to experts from the world of finance. In prior episodes, we've talked to global economists and global strategists out of Australia. We've talked to accounting specialists out of Hong Kong studying Chinese accounting practices. We've talked to commercial real estate experts out of the UK. We've spoken with geopolitical experts from across Europe and a whole host of other experts from the world of finance. So I'm excited in that vein to bring to you today and introduce you to Hardy Bowen. Hardy Bowen is a Wall Street veteran. He started on Wall Street in 1968. He's been a specialist in the US consumer and the US economy in particular ever since then, following all things retail and investing in retail stocks across the Western economies and particularly in the US. So it's without further ado, I bring you this conversation. I hope you enjoy it. Well, welcome, Hardy. Fabulous to have you on the show. Really looking forward to talking to you. Appreciate you taking the time.
Great to be here.
Good to be here. And I understand this is your first podcast,
Yes.
which way overdue, I must say. Way overdue, tapping that brain and all that knowledge that you've got in there. I'm really looking forward to what you have to say, because I've spoken to you many times in the past, and I know there's a depth of knowledge which is absolutely fantastic. So why don't we start? I'd love to hear about your career, because I sometimes feel in meetings I've been around a long time, but I imagine, well, I know you've been around a lot longer than I have. So I think it'd be fascinating to dig into your career a little bit and talk us through, where you've been, what you've done, what you think's changed on Wall Street over the years, all that sort of stuff. Perhaps weave that in as you take us through your career from back, I think 1968 when you started.
Yes. Well, there's been a huge change in technology over the years. And that's the biggest thing. When I started in 1968 with an MBA, my job was to respond to wires from offices in Haydenstone. They had 100 offices, second largest retail brokerage house in the United States. People would wire me and say, "What is the dividend on General Motors?" If you can believe that. I would go to the library, open up a book, get the dividend on General Motors, and send it on a wire back to the office. That was the state of technology in 1968.
I love that. And when you say a wire, just for those who aren't familiar with the term, what do you mean?
Well, it's like a telegraph wire or something. I mean, it was that. There was no internet, no nothing.
It was the precursor to the fax, I assume.
Yes, well, before the fax.
Way before the fax. Yeah.
Yes. And so I was hired in October of 68, and in December of 68, 2 or 3 months later, the second largest brokerage house on Wall Street. The mafia, they were switching paper certificates to online, and the mafia infiltrated the back office and stole $10 million worth of IBM securities, and Haydenstone failed its reserve requirement, had to be rescued by somebody from Oklahoma to prevent the whole system from going down, from fails to deliver. And they fired half the research department. So they had a 40-man research department. They fired half of it, including me, my boss, and so forth and so on. So I said, this is a terrible business. Jeez. You get a job 2 or 3 months later, you're fired. I think I was making $7,500 at the time. And so I went out to look for another job, and I got hired. And the person said to me, "Well, you have experience. How does 9,500 sound?" I said, "That sounds pretty good." I had no experience whatsoever. I was going to analysts and saying, "What's your opinion of General Motors?" Writing down something, sending it out on wires, sending dividends out on wires. That was it. But at A.G. Becker, it turned out I was in the institutional research department, went to visit companies and so forth and so on. But downstairs in A.G. Becker, they had a division that was going to small institutions. And out of that division, That's the place where you should have been, because Bob Wilson was down there, who was the original hedge fund guy who took, I don't know, some family money, maybe $50,000 to $1 billion, all his own.
Wow, that's
He
not
was
the
one of the most
Jones
famous guys on Wall Street. He was the Barron's Roundtable head guy for years.
Okay.
Gilbert Gagnon, who was spectacularly successful in growth stocks, although he almost went bankrupt in '74, but has contributed hundreds of millions of dollars to the New York Library and various things in New York City. They were downstairs. Weiss, Peck, and Greer were downstairs, who created the mutual funds. And Bob Birch was down there, another luminary, and so forth and so on. But that department down there had all the famous people.
Yeah.
Even though we thought we were big in the institutional department, and they were small down there. So I think the main thing today is that technology is so much more sophisticated, and people are more sophisticated than they were, both in terms of looking at economic data, looking at market data, looking at puts and calls and all this kind of stuff. Then there was nothing like that, really.
Yeah. Do you think that, and do you find the market's a lot faster? People often ask me about that. Yeah.
Yeah, it's much faster. It's better informed. I don't think you have the degree of stupidity that you had then in some things like the computer leasing companies. And I mean, I remember when I went to NYU, there was a guy, Lee Seidler, who worked for Bear Stearns, and he had a course, the second accounting course was how to cook the books. And for years, he made a living in exposing false accounting in companies, major industries. And the opportunity then to short things for Robert Wilson was huge because of this. Some of the Atlantic City casino things, computer leasing companies, on and on. You don't have that now. In fact, when the hedge fund business, when you had George Soros, you had Julian Robertson, Tiger, and they were the two biggest ones. But there weren't very many hedge funds all through the 80s, and then they exploded in the 90s. And there are not enough shorts to go around for the hedge funds. So you just get over shorting of securities. And the hedge fund concept is a very difficult concept because of that. There's just not enough silliness and not enough companies to short.
Yeah.
So I think that's a factor.
That's a factor. Interesting. I was going to say, I suppose that's GameStop, isn't it? GameStop was overly shorted, which is why it had that initially that big rally, wasn't it? It was more than 100% short, I think.
Yes, it can be dangerous to be short some of these stocks, even though you know that they're not worth what they're worth. But it can be dangerous to be short them. And it's interesting. Well, with George Soros, who was very connected to Arnold Bleischroeder, he started there in fact, Stephen Kellen, who was the co-chairman, met him in a wedding reception line in London and persuaded him to come to New York. And he worked as a trader.
He was at Singer, wasn't he, in Friedlander in London, if I remember rightly, back in the day. Maybe. I think. But just so you actually never got to the fact that you did start work at Arnold Bleischroeder, I think in 1978.
Yeah.
Just to complete the picture, before you tell us about George. So you were Hayden Stone, A.G. Becken, Calvin Bullock, is that right? And then by 78 you were at Arnold Bleischroeder, and George Soros turns up on the scene, or he was there when you got there.
He'd already formed his hedge fund by the time I got there. But he was the head trader first, and he was doing a lot of trades. And people said, "Well, you're doing too many trades." He says, "Well, if I'm balanced, the trades are successful. The more I do, the better." That was his.
Yeah.
But then he became the director of research, sell side, for Arnold Bleichroeder. And so we used to go out and see clients, and they would say, "Well, we haven't seen anybody since George and Jimmy Rogers were the two that had come." That was the institutional research department. All domestic stocks at the time.
So you mean him and Jimmy Rogers basically they ran the trading desk and they ran the research department. In fact, they were.
Well, I think they by that time moved over to the research department, and I think the trading desk was somewhat separate at that point in time. But you have to give him a lot of credit, because when he first formed his first mutual fund, the hedge fund, he made a big bet on U.S. Treasury securities. That was his big bet. And it went the wrong way because he was just too early. He was long leveraged U.S. securities, treasuries, long treasuries, and interest rates went up in 81, 82. And the fund, I don't know what happened, but it was something like a 50% decline. And then he was persuaded to come back into the business by various people because he'd been successful before, but particularly the head of a major Italian bank. And he came back and made the exact same bet the second time around and worked for the next 20 years.
That
amazing. Just shows how fortunes can go.
It is right time, right place, isn't it? But people obviously saw he had a talent, and he obviously demonstrated that over a long period of time.
Who was co-chairman of Arnold Bleichroeder, backed him big time the second time around, and along with others, and they liked him, obviously.
And did you interact with him at all? Did you have any interactions?
He was elsewhere. In fact, my only interaction was when I first came to Arnold Bleichroeder. I wrote a 70-page report, because this is what people did on McDonald's, by recommendation. And the first thing I heard was, "George Soros is short." Well, he was short, and he was correct, because it was an energy crisis, and gasoline prices, they were gas lines and whatever, and people weren't shopping in McDonald's as frequently. And but then over time, I was correct. So, but I never wrote another 70-page report. It was ridiculous.
Did you realize it wasn't necessary? Was that the thinking?
Yeah, not necessary at all. I mean, nobody would read the thing anyway. No portfolio manager who made a decision would read it. So
it's amazing.
First page.
It's amazing, isn't it, how there's Wall Street and the City of London's analysts' obsession with these decades, sort of tons of pages of reports. And you're quite right. I mean, we'll get into this, but only 3 or 4 things ever really matter, don't they? I mean, perhaps when you're thinking about the company specifically, there's a bit more understanding of strategy and all that. But 3 or 4 macro factors have a big effect. I was actually listening to Scott Bessent the other day, who I think was a protege of Soros, I think, or maybe Druckenmiller, I forget which. But he was saying that sort of 80% of most stock picks is macro calls. And I know you love your macros, and we'll definitely get to that in a minute. But Arnold Bleichroeder, 78 to 2008. One brief interaction with George Soros, which didn't go your way.
And then we were Soros's back office forever. So there was a big back office connection. And of course, Henry Arnhold was a big investor in his fund, and so forth and so on. So they were pretty close. But then somewhere around the early 80s, we had an international research department upstairs, domestic research department downstairs, and the international research department really didn't do too much. Newspaper clippings or whatever. And
Right.
we were very aggressive domestic analysts. And not me, but one of my associates got the idea of doing foreign stocks. So he asked, well, can I do foreign stocks? Well, okay, you can do this and that. So he went and did Novo, I think, and Heineken. And when Heineken was selling at 6 times earnings and depreciating land and so forth and so on, we started selling these to U.S. institutions. And that was a much better business than the domestic business because, strangely enough, Morgan Stanley, Goldman Sachs, whoever didn't have international departments that were doing anything. And a lot of mutual funds had these requirements that you had to have an ADR, American Depository Receipt, in order for them to buy it. So you had sponsored ones, which was very costly, and you had to file quarterly reports with the SEC, so on and so on. But you had non-sponsored ones. And so we got non-sponsored ADRs going. Although in a lot of cases, people bought the stocks and the non-sponsored ADR never showed up. But that was the business.
What do you mean? What didn't show up? Sorry.
Well, the Bank of New York did the non-sponsored ADRs. And so we would, for a non-sponsored ADR, you just filed your regular reports in Europe and didn't have to file with the SEC, so forth and so on. But you had to agree to do it, and then the Bank of New York had to set it up. So we would call the companies, we'd press them to do the non-sponsored ADR, and yes, it's coming. And then it would take time, and then the Bank of New York would have questions, and it would go back and forth. Meanwhile, in many cases, the stocks were going up, and so everything was fine, but the compliance officer at the mutual fund would be calling, how can you own this stock? It doesn't have an ADR, and there would be that back and forth.
So all that can, yeah.
So we had the other thing was that these stocks did not show up on the screen, bid and asked. And so it was kind of a blind market, and the spreads were far, far better than the domestic market. So all of the analysts started doing international stocks.
Ah, yeah. Good business. So when you say it didn't turn up on the screen, you didn't have a European stock price access, or you didn't have the ADR of the European stock? Or could you see what the actual underlying was doing?
At the time, it's hard to imagine, but we did not have the typical money manager mutual fund did not have the European price.
So you didn't, so you would literally open the paper the next day, or someone would, or you'd have to ring someone up to find out what the price was.
What they had to do, they had to call Arnold Bleischroeder to the trading desk, and that was the price.
Oh, right. They had, so how did they have, they were bid and asked because they were making a market, I assume, but
yeah,
but
they were in touch with the European markets.
Okay, so they're basically on the phone a lot to the European markets, keeping a track of the prices and making a bid ask. Wow, isn't that amazing compared to what we do today? You can get prices on everything everywhere. It's absolutely incredible. So no wonder it seemed more. You mentioned earlier there was more stupidity, I think, or sleepiness, or whatever the word might be. That
or just things that would be totally out of whack.
Opportunity,
and now it's not really. The arbitrage opportunities, if there are such things, go away very fast. So it's
the computers do them.
Efficient, and in some ways it's more stable because of that, except for these monetary crises and so forth and so on, things like that.
Yeah, I was going to say, you say it's more stable, but clients I talk about it being faster and more volatile. How would you marry those two up, would you say, in terms of the market?
The amount of trading that's being done by machines is much higher. And so at times the prices can go astray. And so it is a question of, do you want to own this thing at whatever price it's selling at, so forth and so on. You've got to be a little careful. And then sometimes there are big jumps in prices or big declines in prices just because of positioning and the machines and so forth and so on.
The machines make them.
Yeah. Machines are going to punish it more, I think, than they would have in the old days, where it would have gone down, 2% or something. It might go down 10%. But then it may come back over time. But that initial move is bigger on any positive or negative. And
possibly as we,
you have to be careful of the initial move, because a lot of times the market is going to reverse that initial move, the 10 or 15% move.
Yeah. Interesting. I was going to say it's a bit like what we saw in Japan in late July into August when the Japanese market swooned by sort of 15-20% in a few days. And it reversed quite a bit of it. It hasn't reversed it all. It's actually rolled over a little bit again, but although not last night, but that was very fast, to your point, and probably a lot of machines involved in that, as well as a lot of short covering of underweight Japanese yen positions. But tell me, because we're going to get into the consumer and the US economy in a sec. And I think, have you always been a retail analyst by training? I mean, you're now an investor.
Basically, I started at Calvin Bullock. I had every consumer industry in the United States. And I went and visited all kinds of companies, hotel companies, packaged food companies, cosmetics companies, et cetera, et cetera, et cetera. And I just noticed that retail trade and restaurant companies had major growth, some of them. And so that's what attracted me. It was just the opportunity at the time was spectacular. So when I went to Arnold Bleichroeder, I did retail trade and restaurant stocks in the United States and in Europe. And I mean, Home Depot is unbelievable. I wrote a report recommending Home Depot when they had 10 stores. And
how many have they got now? So 20,000 or something? I have no idea, but
a couple of thousand. Price Club, which is Costco, but the original concept was Sol Price. I wrote a report recommending them when they had 6 stores. And now that's huge as well. But that's another thing that changed, because now the private equity guys are getting in there to these companies. So for Floor & Decor, for instance, which is a spectacular company, they came public with 70 stores. So you missed that first 10 to 70.
Yeah.
On that in the public markets. So that's a deal. But the other thing that has changed big time is the monetary system has changed, because when I first came in, it was a fractional reserve system, and banks created money by they could make a bank loan, not get the money from somebody else. So it wasn't intermediation. Yeah. They created money, made a bank loan. And so the money supply, extremely important, because it was an indication of printing money. And however, more and more, the actual reserves were manipulated in such a way that you didn't have to have as much reserves against assets. So I think starting in the 50s, you had about an 8% of assets were in reserves, and by the time you got to the financial crisis in 2008, 2009, it was down to 1% of assets. So it didn't take much to bankrupt the system.
Yeah, very different.
Bankrupt 2008.
Yeah.
Well, Then you got into in 1980, they took away the reserve requirement on time deposits so that banks could compete with money market funds. And at the end, they just loosened everything so you could, in effect, make a demand deposit a time deposit overnight with no reserve requirement. So that ruined that whole system at that point in time. And then when you had the great financial crisis, you have Basel. And that was essentially, you started a long series of increasing reserve requirements, which is a good thing because you didn't really have a reserve requirement going into 2018.
Yeah. So so what you're saying is you're sort of contrasting the sort of classic pre-Bretton Woods system whereby money creation was pretty clear in the system. There wasn't a financialization of the system, whereas I think really sort of from Reagan onwards, the system opened up, became more financialized, and money creation went into very different corners of the financial system. And it wasn't just when a bank creates money, it becomes a loan and then a deposit, and therefore it goes into economic activity. What you're sort of describing, if I'm reading it right, is that transition from a sort of clean financial system to a more complex one. It's like my father always used to say, sort of in the UK, pre sort of late 70s, early 80s, and in the US, probably a little bit earlier than that, maybe 10, 15 years before, no one had a credit card. You couldn't just, so in a sense, spending money on a credit card is money creation. And it's outside the banking system, a lot of it, not all of it. So I think you're alluding to that, and that switch from a system where you can see all the money in the banking system and the reserves anchor it, and it's easier to control through the reserve requirement, loosen up, and then you create more and tighten. And then we've gone to this over the last sort of really sort of Thatcher Reagan onwards, the sort of Basel based rules, where it's about how much capital banks have, and the systems are much more complex. Is that
Yes. And I think it's hard to see how much money is actually being created by the banking system, because the banking system is half a money market fund. They were successful in making it very competitive as a money market fund, where you could just put a deposit that was semi-illiquid, but not that illiquid. And a lot of money goes in there, and it's not clear how much of it's being used for operations or to do things, and how much is sitting there as a money market fund. And then the reserve system has been changed. And, I don't know why we have that item in the Federal Reserve statement that says factors affecting bank reserves. Well, what they mean by bank reserves is the deposits of the banking system at the Federal Reserve. Well, that's not bank reserves anymore. And bank reserves are tangible common equity as a percentage of risk-weighted assets. So you really shouldn't call that bank reserves. I mean, you can call, I don't know what you want to call it. Just call it deposits by the banks at the Federal Reserve. It's an important number, but it's not bank reserves. And they keep referring to it as bank reserves.
So to be clear, so in going back to pre-1970, the bank reserves the commercial banks held at the Fed were effectively bank capital.
They were. Well, you had a reserve requirement: 10% of demand deposits, 1.5% of time deposits, and how you met that reserve requirement. They were bank reserves. So when you cut the reserve requirement, it meant something.
I'm with you. So probably, I guess that's basically how the Chinese system still works. I don't know if you look at China at all, but they cut their reserve requirement ratio the other day, and that's one of their mechanisms.
Yes.
So that's how when you started, how the banking system in the US used to work.
What we were taught in business school, the fractional reserve banking system. Yes.
Yeah.
That was Milton Friedman and the whole thing.
Yeah, I was going to say, I was listening to Milton Friedman last night talking, giving some, on YouTube, there was some speech of him from the early 80s. And of course, I was thinking that feeds straight into that classic monetary approach to the economy. Whereas today, I think we'd say we create a lot of money and it gets lost in the financial system, or it gets lost in housing. It ends up in houses and stuff like that. So how do you so I've heard you speak many times in the past about the Fed, and it's always been fascinating, and how you used to think about the Fed. How do you think about the Fed now, though, when you're thinking about, because you talk about the consumer a lot, so you think a lot about the US economy and the way it works, and we'll get on to the consumer specifically. But when you're thinking about that whole big picture puzzle,
Yes.
how does the Fed factor in?
Milton Friedman said inflation is always and everywhere a monetary phenomenon. But the way I think about it is inflation is always and everywhere a personal income phenomenon, which is you can print money and very rapidly you will create a lot of personal income. But personal income is the demand for goods and what buys the goods. And you can create it by printing money, but you can also create it by tax cuts. And I think that Milton Friedman is a very data-driven economist, brilliant, monetary history of the United States, the whole thing. But he was, at the time, everybody wanted to be 100% fiscal, and he was fighting that battle academically. So he wanted to be 100% monetary. But I think in the United States, that in 1964, they had a tax cut. They had full employment economics. So the whole idea was a gap between where you were and full employment. This tax cut was going to cover that gap. Well, it raised the personal income growth rate to 8.5% after taxes. When the economy could grow 1.5% employment and 2% productivity, so 3.5%. So you had an implicit 5% inflation rate embedded in 1964. And the inflation rate started moving up from that time, but your currencies were fixed until Bretton Woods, 1971, I think.
Mm-hmm.
So you went 7 years of fixed currency, but as soon as you floated the currencies, the dollar went down 25% against the Deutschmark. And inflation really took off in the United States then at 71. From 71 on, you had 10% growth in personal income. And sometimes 10, 11 for the next subsequent years, 3.5% real, implied 6.5% inflation. That's pretty much what you got, plus some catch-up inflation along with that. So I want to look at personal income growth. That is the key number for me. Looking at the consumer, looking at the economy, looking at inflation.
Yeah.
And when we gave all those credits to people after COVID, we got our personal income growth rate up to 10%. At the beginning of 2023, it was still running 8, 9, 10. Well, that implies a lot of inflation. But since then, we're now at a personal income growth rate year to year is about 5. But in the last 6 months, it's been 4 at an annualized rate. In the last 3 months, it's actually been 2.4% at an annualized rate. So it's slowing. And I think that means the nominal economy is going to slow, that personal consumption is going to slow. Now, whether that 2.4 is an aberration, probably that's too low, but I think we're slowing towards 3.5, 3, maybe something like that. And that's going to slow the economy.
Let's come back to this in 1 second, because this is a really, really important point. But I don't want to miss what you were saying about Friedman and let it pass, because you made some really interesting comments there about the idea that Friedman was 100% monetary because at the time, policy was more about fiscal. And of course, I don't think people appreciate
all Keynesian, all fiscal.
They don't appreciate that now, that because we've grown up with 30 years of monetary policy running the show. But there was that view, wasn't there, that Keynes, you control the economy with fiscal levers, forget the monetary levers. It's all monetary was perhaps more anchored because of the Bretton Woods anchor on the monetary system, I guess, and the currency's fixed.
Well,
And
in Keynes' time, it was largely a gold standard. So, he was going off of that. So, I mean, he was correct about fiscal policy into that system.
so
But
Friedman, but Friedman, therefore, was batting against the how does all that fit in coming from? I'm just trying to think of the times he was, the 50s and 60s when he was coming up with his theses and fighting the battle, as you said, because I could hear that on the podcast yesterday, discussing with other academics from that time. They were.
I think really the thing that changed people's mind was the monetary history of the United States. He started doing research at the National Bureau of Economic Research with Anna Swartz.
Yeah.
And the numbers are what persuaded him that monetary policy was very important. And then he wrote down, starting, I don't know when, right after the Civil War, monetary history of the United States. And he went cycle by cycle, market by market. And he pretty much saw when the money supply went up, the economy went up, money supply went down, economy went down. And you just followed that graph for 100 years. And
that's so interesting. Yes, because again, back to this podcast I was listening to.
It wasn't a theory, it was data.
It was data. But back to this theory, this podcast I was listening to, the other academics arguing with Milton was saying, in fact, I think it was the head of the Fed at the time. He was talking, an ex-head of the Fed, William Chesney, I think he was talking to in this podcast, who was making the point that, well, I want to make sure I fund the government when they ask me to be funded as the Fed, which I think is to your point. If the government wants to do some fiscal activity and they need some funding, if I correctly understood what I heard, then the Fed was happy to provide it because fiscal policy was the dominant policy, which is kind of fitting to what you said, which is kind of interesting to me. Yeah.
Yes. And more recently, I mean, the fiscal policy caused the inflation. I'm absolutely convinced of it. Now, it might have been accommodated by the monetary policy, but the monetary policy, it wasn't their idea. It didn't come from the Federal Reserve. It really came from the fiscal policy that caused the inflation. But now that's over. And the other thing about inflation, I just don't believe in inflation expectations at all. I think it's supply of goods, demand for goods. Demand for goods is personal income growth year to year, pretty much. And whatever that comes out, that's what you get in prices, because it's thousands of markets. I mean, companies can try to sell things at some price. They don't sell, they cut the price. It's it, and it's instantaneous. So I don't want to pay any attention to inflation expectations whatsoever.
Which is a really interesting point, Hardy. Go on, keep going. Sorry.
I want to pay attention to personal income growth after taxes. How much money do people have to spend? And the relationship of that to what they're spending now, because I think in the last months that you've got less personal income growth than spending. There's about 100 basis point gap, and therefore that spending is going to moderate over time, most likely. And so I think that's as far as
critical.
Determining inflation, once you get to even personal income growth of 5%, you're not going to have, I mean, people were talking 12 months ago about 70s inflation and all this kind of stuff. In fact, Powell was even saying, if we don't do something, there'll be 70s inflation. Well, no, there won't be 70s inflation if you have 5% personal income growth. There might be 2.5%, 3% inflation, but not 6%, 7% inflation.
It's impossible.
There's not enough money to buy the goods.
Yeah,
that's it. So, yeah,
that's fascinating what you say, because I think for those that aren't familiar with central banking, it's worth just reinforcing the point you just made, because a lot of central bank models now are inflation expectations is the guts of them, as you know.
Yeah.
And of course, that's, the what are they, dynamic, stochastic, general equilibrium models that pretty much every central bank around the world has inflation expectations at its heart. And in fact, they assume that inflation, if they're credible, they assume inflation will go back to where it should do because they'll get its expectations under control.
Yes.
And this is the amazing point, because you're arguing that that is utterly irrelevant, yet that is the heart of central banking today
Yes.
in pretty much all central banks.
I know it from the
It's a
company's
frightening
point of view,
thought.
because every retailer for Christmas is a big season, and so you have a plan for Christmas. So you're bringing in the inventory and so forth and so on. And I've just watched this every year. You bring in the inventory, demand is better than you expected. You outsell the inventory. February to May, you place your orders for next Christmas. They're going to be higher. You don't sell your inventory, they're going to be lower, and you're going to demand price concessions. It just is, whatever your plan is a business. If demand doesn't meet it, you're going to react to that immediately. You're going to demand from your suppliers lower prices if you don't sell what you have to sell. That's it. And you can just see this. I mean, you can see it in this cycle. It's like we have a company, RH, Restoration, the old Restoration Hardware, RH. They sell very high priced furniture. Well, existing home sales are down 25% below normal. You don't sell a lot of furniture. Doesn't mean demand. What do? They go back to their suppliers. We can't sell the kind of volumes you want to sell and we want to sell, and so forth and so on. And they lower prices 12%. That's
As simple as that.
It's not. It doesn't matter what you think inflation's going to do over 5 years, 10 years, 2 years, or anything else. The fact is, you didn't sell the product. Prices have to go down.
They got to go down. So how do you weave wage inflation into this then? Because there's obviously, economists get lost with this idea of, do wages drive inflation, or does it wages respond to inflation?
Well, I think it's the same thing. If you don't sell the product, you're going to cut the people or just not hire new people. So it's the only variable cost that businesses have. I mean, you put up plants, stores, warehouses, whatever. You can't turn around and sell those stores, say, well, I shouldn't have opened that store. I shouldn't open that plant. I want my money back. Well, no, it doesn't work that way. You can't get your money back. So you look around at your cost structure that's variable, and it's all people and wages. So wages have to go down and people have to go down. I mean, that's it. It'll be the same reaction. And I think it is already taking place, in the sense that for a while there, in technology jobs, they're putting a job out at, say, $200,000. And now apparently the same job they're putting out at $170,000. And that's enough to attract whatever they want. And they don't want as many people. I mean, people like Amazon or whoever, for a while there, in order to hire any new person, there was a ban on that. But then in order to hire somebody to replace somebody, you had to have a special dispensation as well. So the technology companies cutting jobs because they don't need those people. And I think effective wages are just going to go down gradually. And it's a question about employment, because when you get down to employment, we're now focused on the unemployment rate, according to Powell.
Mm-hmm.
Well, the unemployment rate is based on a household survey of 60,000 households. It has enormous variability. The variability of the regular employment number that's coming out tomorrow morning, 90% confidence level is 100,000 plus or minus. For the household survey number, the 90% confidence level is 600,000 plus or minus. So you can get some big jumps in the unemployment rate. I mean, it could go up 0.2, it could go down 0.1. It probably is all wrong, both of those, but the market will react to it. when it happens. And I do think for employment that the Federal Reserve is probably underestimating productivity. I mean, most people really believe that productivity is 2%, and some people believe with artificial intelligence, it's going to run 3 or 4 for a couple of years. I don't know, but I think it's probably 2%. So if you think about that, if you get real GNP growth, which is their forecast down to 2%, you don't need any more people.
Mm,
That's it.
yeah. Yeah.
Now you're
2% gives you 2% real.
Yeah, you're going to get more people because healthcare is going to hire people and other people are going to be slow to fire people. And state and local government has been funded under the Infrastructure Act for the first time. I mean, for years, state and local government had no money after the financial crisis. They couldn't build roads and do things, and they had to cut people. They couldn't hire people. Now, if you look at the employment growth, it's state and local government and healthcare in the United States. Not much else.
Mm. Isn't that troubling? Isn't that troubling?
I think it is. I think state and local government is going to fill themselves up with people, and they don't have more incremental revenue coming in on top of what they have off the Infrastructure Act. So I think they're going to slow down. Healthcare is going to keep going just because of demographics. But the rest of the economy is not so strong, as shown by the ISM index.
So where's the economy going then, do you think, over the next 6 months? Do we fall into recession? What happens to inflation? What would your central forecast be?
I think we probably don't fall into recession because the consumer's balance sheet is very strong, and housing prices have gone up dramatically, and people can access their housing prices over time. And I think as interest rates get cut some, they've already been cut a lot, the mortgage rate, that people will access. I mean, refinancing is up more than double from a very low number.
Yeah, it's really started to move, hasn't it, in the last month or two? Yeah.
Yeah. So I think those, and you've pointed out the state of corporations is much better than it was previously. And so because of all that, I think we're not going to have a recession, but I do think we're going to have a slowing. And, if the Federal Reserve was really paying attention to the household survey, they would have cut 6 months ago, because the household survey shows no growth in employment over the last year.
Yeah. Yes, it's been much more softer, hasn't it, than payrolls?
Yes, and it's not clear. They have not diverged by this degree very often. And it's just not clear, but if you take the average of the two, things are weaker than you thought. And I suspect you need to get nominal growth. If you want 2% inflation and you want employment, most people think the labor force is growing 1% right now. And if productivity is 2 and real is 3 and inflation is going to be 2, you need 5. Well, you're falling short of that on the income line and starting to fall short of that on the spending line. So all those numbers are probably going to be lower. And I think one thing about inflation, if it's going to be 2% over the cycle, there's a great tendency for it to be higher than 2% when you're slowing the economy down and lower than 2% when you're speeding the economy up.
Yeah, so it lags. Yeah.
Yes.
Okay.
And so I think they'd probably be wise to be cutting faster. But if you're looking at inflation numbers, you might not cut so fast. It doesn't look like they want to cut, because there was a lot of people who had only 25 basis point cut for the rest of the year. I think 9 out of 19, something like that. So I think those are those are the problems. I mean, you could imagine a scenario. I don't know if it's maybe a 50% chance, but a scenario where employment goes down to very little and the unemployment rate, I mean, it goes to a growth rate of 0.4%, let's say, labor force grows 1% and unemployment is 4.8 or something a year from now, or heads that direction. And then I guess the market probably will not like that scenario.
Yeah.
But the Federal Reserve will be behind the curve and have to cut further.
But do you not think it's normal for the Fed to be behind the curve? They're looking at lagging indicators, as you said, inflation and employment, and responding data dependency. I mean, almost by definition, you have to be behind the curve.
Yes. Yes, I think that, in my mind, they should concentrate on personal income growth after taxes, which is a combination of employment and wages and some other things. Concentrate on what nominal growth rate for the economy they want to achieve whatever objectives they want in real growth and inflation. Look ahead, forecast that, act according to that, forget about inflation because and I think it's all inflation expectations that does it. They have this kind of phobia about expectations that somehow it gets started and it runs on its own. It doesn't really. It runs on income. So if income doesn't increase, you're not going to get inflation.
No. I mean, it's a theory born out of the 70s, isn't it, basically? I mean, it was born out of one decade when there was little control of the money supply. I think it'd be fair to say, having come off the anchored Bretton Woods in 1971 and no one really thinking about controlling the money supply for several years until Volcker turned up. And you're right, it's now embedded in central banking in inflation expectations, which is a great example of how economics has this habit of looking at yesterday's problem rather than tomorrow's. Sadly.
I'd like to run the monetary policy like you would run a company. What do? You run a spreadsheet, detail for the next 2 years. You look out 2 years, then you think about the 5 years after that. But it's all based on what's coming, not based. Of course, you use all the pieces of information you have to predict what's coming, forecast it the best you can. And I think, this is China's problem, is they don't have enough demand to buy the capacity, to buy the goods. And where's the demand? The demand is in the consumer. Well, it's an Asian thing. Was the Japanese problem, terrible problem, overcapacity that they got out of to some degree. But China has the same problem now. And I'm not sure that I'm sure that just cutting interest rates isn't going to do it. I'm not sure that if they cut reserve requirements enough, they might be able to turn the economy. But in their particular, with a very high savings economy, are they going to be able to create the consumer demand? I think you're going to need tax cuts or almost subsidies or something that hits the consumer directly to create the demand to get out of this overcapacity situation, which is deflationary and difficult. So,
does the China situation play a lot into your thinking on the States? Do you spend much time? No,
I don't spend really any time.
But it's fascinating. I agree, and we think about it a lot. I mean, it's a fascinating topic, and China looks very much like Japan in the early 1990s in many ways, and it is in a balance sheet recession. So I think you're absolutely right. A few cuts isn't going to cut it. It needs something very, very substantial. And for China, really, probably they really have to realize their losses.
It's a big psychological factor, I guess, and it might have some influence on commodity prices and all that kind of stuff.
Yeah, it's important for that. Okay. So not a recession for the economy, probably a soft patch. How long does it go on for? And and what do you and how do you? And because you obviously run a retail fund, as in you invest in retail consumption stocks rather than you take money from retail. How does it? How do you go about investing into this environment? What are you thinking about? What are you looking at? What's interesting to you?
Well, you have to modify your sales forecast by 1 or 2% going into next year. Now, most of the companies I deal with are growing fairly fast and dominant competitors. All of them are dominant competitors. And so it influences that. Interest rates, I suspect, may end up going lower over time than maybe more like what the market thinks than what the Federal Reserve thinks, because I just think the economy is going to come up short.
Yeah. So you could see, so markets thinking about a 2.8% Fed rate by the end of next year. You think that seems very credible? You would bias lower or bias a bit higher?
I think maybe that's about right if Donald Trump is not elected president. If Donald Trump is elected president, then you have a problem, because he has the power, if he really, really wants to use it, to do things like increase tariffs 10%, increase the tariff on China 50%, which is like a major tax increase. It will raise prices probably 0.9%. It'll probably stop the Federal Reserve from lowering as much, and it'll take a fair amount out of real consumer consumption. It'll be a 1-year thing, but it will take out. So I think the market at some point, if Donald Trump is elected, I think it's bad for the market. It's bad for consumer goods stocks. Whereas before, when he was elected, you wanted to run by.
Yeah, interesting. So are you saying, am I hearing you correctly? Are you suggesting that the election of Donald Trump could actually tip the US into recession?
Get it close. Yep. Get it close. I mean, I think if it's a recession, it'll be one of those mild kind of things that not a real, there are recessions and recessions. Won't be like 2000, 2001, even, and nothing like 2007, 2008. I mean, it won't be a big recession, but it might get you negative GNP slightly for 6 months and be called a recession, possibly.
So fascinating. So completely different effect, as you said, from 2016 when he was elected and he juiced the market with the tax cuts.
Yes.
What about the tax cut story?
I've talked to a lot of chief executives who run big companies, retail, trade, restaurant companies, whatever. None of them, and there's no reason why they should, understand the economy at any real level. And Donald Trump doesn't either.
Yeah, well, that's certainly true. that's not a surprising statement.
As I read the situation, the United States has higher interest rates than the rest of the world, has attractive kind of stock market and rule of law. And if you're thinking about putting money someplace, it probably is the safest place to put money. And every year we have a certain amount of money flowing in for that reason. And that drives up the dollar to the point that it creates an offsetting trade deficit. Because if you have money coming in, supply and demand, you have to have money going out. I mean, you've got to have, the markets have to balance.
Has to balance,
I suspect that if you raise tariffs dramatically, you're not going to cure the problem that the dollar is actually going to go up sufficiently to maintain the trade deficit that you need for the money flowing in. Now, if you can stop the money flowing in, but you probably don't want to, that would change it. But I think the trade deficit is going to stay. And a danger is that a lot of imports from China specifically go into the components of the goods that are manufactured in the United States, the automobiles, the seat covers, they're just very, very good at this kind of labor productivity kind of thing.
Mm-hmm.
And if the United States is paying higher prices because of the tariffs, the car companies are paying higher prices for those goods than Europe is paying, or Japan is paying, or South Korea is paying, then the United States is not going to be a good place to make cars, not for United States companies, not for German companies, or South Korean companies, or Japanese companies. They're going to make more cars in Japan, South Korea, and in Europe.
Mm-hmm.
So I think it's going to hurt the competitive position of the United States industrially if you do that. And
ironically, that's sort of classic Friedman, isn't it? I mean, politicians have one idea and the reverse is the consequence.
yes,
It's often the way, isn't it? It's like price and rent controls. Control the price of rent, of course, you make the market worse because no one's incentivized to build.
yes.
Yeah. And same with tariffs, I guess, is your point. You put tariffs on, then you're discouraging people from industrializing and operating in the States. They're better off operating elsewhere. So okay, that's interesting. So how would you see the Kamala Harris presidency for the consumer?
Well, a lot depends, and beyond that, if the House and the Senate are split. I mean, if she were president and had both House and Senate, but it seems unlikely, then I think she would do some things, but it's more marginal. I don't think it's anything that's going to move the needle very much.
What about the CGT tax she talks about, the 28%? Is that still on the table if she gets? I mean, I understand that the Senate's probably going to be Republican, but in the odd chance she gets a full house or clean sweep,
she would try to do it. It's already been cut back because originally it was higher than that. She cut it back from what Biden was proposing,
right?
And she does have a couple of Wall Street guys who are chief economic advisors. They might be wise enough to moderate it a bit, but yeah, I think it would be bad.
Yeah,
I don't think it's a good idea. It's 28% plus 5% surcharge, so it's actually 33. So what's being proposed by her now?
Okay, how bizarre! What an unusual way to do it. Why would you do 28 plus a surcharge? Why not just do 33?
Obama put a surcharge in to finance Medicare, Medicaid, so forth and so on, which is a continuing United States problem. Because every year you need more for these things, and your tax base and tax revenues are not growing fast enough to support it. So he put it in to cure it for 3, 4, 5 years. And it's a 3% surcharge right now, but going to 5 under this proposal. So
interesting.
It's not a great idea. And I think trying to put a bigger tax, 5% on stock buybacks is a terrible idea as well, because stock buybacks create efficiency in the economy. You don't want people who don't have good investment opportunities to be pouring more money into low return on equity stuff. You'd rather have them buy the stock back, give the money to other people, and let those people do high productivity things. So I just think that's a bad idea. So yes, she has the standard Democratic things that are marginally probably not so great. Bad.
Yeah, but not as bad as Trump. So what about so how do you go about you're just sticking with companies what are your top picks at the moment? Do you have top picks on consumer stocks or?
Well, the way we do it is we want things that grow, and we look out 2 years, run a spread, predict the earnings this year, next year, the year after. Then we look at the 5 years after that, because we think 2 years from now, the PE ratio for the company is going to be based on what people think the 5-year growth rate is at that point in time. And we compare where we think the price is going to be then to where it is now. And that is pretty much what we invest with. Along the way, we do sell call options, sell the upside, sell premium to hedge at points in time if we don't like what's going to happen. So if Trump gets elected, we'll be selling call options, probably strike price down from the current price, rather than selling them 2 strike prices up, something like that. We'll take a hedge point of view. But as far as the companies, we want to look at that potential. And so some of the companies are Floor and Decor, which is wood flooring and tile flooring, but they basically source directly from 24 countries. These sources, Home Depot and Lowe's, for instance, buy through one wholesaler. The real competition for Floor and Decor is the regionals that have the full selection of items, like 1,000, whereas Home Depot might have 50. And those people buy from 2 wholesalers. So their cost of merchandise is about what Floor and Decor is selling it for.
Because they've got less middlemen. There's less the shorter supply chain. Yeah, no middlemen. They literally source direct. Their competitors, have wholesaler.
They run a 43% gross margin, whereas a lot of tile retailers run it. It's a very low turnover business, but a lot of tile retailers run at 70% gross margins. So there's a huge difference in price, 40-50% versus those guys. Now, existing home sales, single family existing home sales are 3.5 million right now. They ran 4.7 million for about 10 years. It's more normal. So we're in a depression or major recession
in housing.
And existing home sales type related things, which this is. So Floor and Decor has very poor earnings numbers. Their leading competitor, LL Flooring, that also sources direct and has higher gross margins, higher prices than Floor and Decor, but it's still a very good competitor, lower than Home Depot and Lowe's, just went bankrupt. So that shows the kind of pressure that's in the market. And so
last man standing, or last direct sourcing man standing, so to speak.
Yes.
Yeah. So probably quite a cheap stock at the moment, I would guess.
Well, that's one of the problems, is not a cheap stock, because as soon as people got the 50-point rate cut, they bid these stocks up. And the idea of cutting interest rates, they bid the stocks up. So this is a thing of the markets being much more efficient than they were in the past. So it's now selling at a very high PE multiple. So it's attractive, but it's really attractive over a 5-7 year period. It's going to be slow to get existing home sales back. I think they'll start in November being up substantially. They'll be up about 8% next year, but that puts you at 20% below normal for next year.
Yeah.
So earnings are still going to be low next year. And the way the market kind of reacts to this, if you get a point where people think the Federal Reserve is not going to lower interest rates as much, Donald Trump is elected, and you may have a soft patch in this stock.
Yeah.
So it's a tricky thing, but it's a very tremendous company on a 5-10 year basis.
Well, they're not got better volumes if they're
internationally as well.
Sorry, will they not get better volumes if their main competitor's gone bust, or will someone pick up that carcass out of bankruptcy and resurrect it, do you think?
They will. It's they're going to pick up a couple of percent, 2-3%. Unfortunately, the company's not big enough to for them to. That's about what it is, 2 or 3%.
Right. Yeah.
So
okay. So interesting. Yeah.
It's very good. We have another company, RH, which is high-end furniture, but they've cut the prices 12% and so forth and so on. And but the same thing exists for them. They're coming into Europe, by the way.
Okay.
And it was kind of funny. The U.S. analysts are saying, "Oh, Europe is going to be this, Europe is that, and so forth and so on." They opened a showpiece store for the intellectuals and whatever, north of London, an hour and a half.
Oh.
People were only going to go 6 months out of the year, but nevertheless, they took over a famous estate that was redone by Sir John Soames after the War of the Roses. And they did the architecture. It's 70 acres or something. And they've got the restaurants. They've got the furniture store. They got the Sir John Soames library, so on and so on, except nobody's ever heard of it. I mean, that's not being in Europe. That's just a thing for.
Sounds obscure.
And then they took over locations from Abercrombie and Fitch. So they have one in London. It's a tremendous location, but they're putting together 3 buildings. It takes a long time to do this. So this store won't open until the end of next year, and I suspect maybe spring of 26. Paris, they had a store on the Champs-Elysees, fabulous store, 3 stories, 2 restaurants, the furniture store, caviar bar on the 3rd floor looking at the Eiffel Tower. Because of the Olympics, all the construction companies were told to go elsewhere, and they couldn't open. They were supposed to open in September last year, so they're opening in spring of next year.
Oh dear! So
September of this year.
This is their high-end furniture they're selling, right? Hence
yes.
The fancy locations.
Yes. When Paris opens and London open, they will be in Europe for the first time. But opening the smaller stores that they got from Abercrombie and Fitch, they opened one in Munich, one in Dusseldorf, which the location's not great. And they, American retailers, I hate to say it, but they don't understand Europe.
They don't understand European consumers. It's interesting you say that. I was going to ask you, because I know you've followed a lot of companies over the years that are in America and in Europe, so you understand the location of stores and the different types of consumer. So actually, it's the location. It's a different ball game in Europe, isn't it, from the States? It's a different mentality, I think, isn't it? In America, you drive to a place and all the stores are there, and we do a bit of that in Europe now, but less so.
Not much.
It's more, not much.
You're
right.
Space in the UK.
That's true.
I think their store in Mayfair will be spectacular. It's in the right place. Everybody will come. Nobody in London is driving cars around anyway. But people will come. And on the Champs-Elysees in Paris, that's fantastic. People will come. But don't talk to me about opening in Manchester or kind of business you're going to do in Manchester or Glasgow or Edinburgh or Birmingham, for God's sake.
Yeah.
You're not going to do any high-end business. I mean, yeah, you can do a little. So they're disappointed. They mailed out catalogs, disappointed in the response. Well, don't mail them to those places. London, just do London. That's where the money is. That's where the high-end real estate is. That's where the furniture sales are. London.
Yeah.
Don't tell me about the rest.
Yeah,
and
exactly.
Then in Dusseldorf, they have this location where it's on the wrong side from, it's on the Connie's alley, so it's right, but it's wrong because it's 100 yards away from LVMH stores on the other side. And when you look in the windows, you can't see anything because there are these narrow windows that go up 3 stories. So you got to market, you got to do emails, you got to be very aggressive to get people in the store. You got a beautiful store inside. When people see it, they're going to like it. You got to be aggressive to get people in there. So.
And do you like, and this is a stock, this is one of your picks. This is a favored stock.
Yes. Essentially, they have, they started with suppliers that maybe did $2, $3, $4 million in business. And they have got those suppliers to 100 million in business. So it's a very high volume. If you want to look, it's hard to say low gross margin, but that's what it is. High volume, low gross margin.
Yeah.
They have no stores, they have showrooms. So no merchandise leaves the store. It all goes from distribution centers. 50% of the sales come in over the internet, 50% through the stores, but actually it all comes from the internet because the stuff that comes from the showrooms is coming from the internet. So all those distribution centers.
So all these shops in the Champs-Elysees and Mayfair, these are basically showrooms where people go and look at the stuff and touch it and feel it. And then if they're talking to someone there, they basically put the order through the internet and it gets delivered, or they buy through a catalog. Interesting.
Yes.
Well, I think they'll do very well in the Southeast. There's a lot of people who like spending a lot of money on their houses in London and the Southeast area in the UK and as you say, all those cities. So
I have that store at $140 million, and I've got Champs-Elysees at $80 million. But the other little stores and the one in Munich I have at 30 million and Dusseldorf 20 million. So that's the comparison.
Okay. So you actually forecast the individual stores. Is that where you're?
Sure.
Yeah. Wow. Okay. So that's a full deep dive. So, and how long, just to sort of, I realize the clock's ticking and time's going on. How long have you been running this fund for?
Since 2008.
Since 2008. That's fantastic. And I assume it's got a great track record, and that's why it's stuck around for so long.
Yes.
And well, congratulations. I really appreciate that. Now, Hardy, I've got to ask you one last thing before I let you go, because I think if I remember rightly, you've come up with what I call an original economic theory, and I often quote it to people. And I'm 99.9% sure it's you that told me the theory of the positive Christmas surprise or negative Christmas surprise, which you sort of half alluded to earlier. Will you quickly talk us through that? Because I love that theory.
Basically, the retailers in February make an inventory plan for Christmas. And then they go to source goods. February through May, they place the most efficient thing is to place orders February through May in volume in China or wherever you're bringing it in from. And you have to predict the next Christmas at that point in February. So you come around to a Christmas, you don't sell your inventory. In February, you then predict a low Christmas for next year. And you go to the suppliers with low end. It didn't sell at this price. We need it 5% cheaper, that kind of thing. And you then build up a low cost inventory and less of it. Usually, at the time following the negative Christmas, the Federal Reserve is on the move and fiscal authorities are on the move trying to get the economy going. So if anything, demand by the next Christmas starts improving, but you've got a lot less inventory at lower cost than you had before. Then you get the positive surprise and the reverse happens. You place more orders and so forth and so on. So it's just a factor in the overall.
It's a cycle. And of course, a lot of retail sales happens at Christmas time. So it's a critical part of the economy. And I remember before you saying you can almost see it feeding into the ISM new orders post Christmas time in Jan and Feb. and often they have quite a strong move, and the price cuts into Christmas if there's too much inventory, or the reverse if there's not enough.
Yes.
And I think the other tweet I remember you saying was sort of Feb to May is the initial planning, and then July, August is a bit of a tweak phase when maybe some more orders go through to China.
It costs more to order it then, but they do to adjust.
They do, if the economy seems a bit stronger as they get into the middle of the year. So I love that. Thank you. And that's it. And that's a great note to finish on. So I want to thank you for your time. It's been utterly fascinating, and I'm glad we've been able to have this conversation. And after many years of hearing you talk about all these things, it's very interesting. I'm going to be watching the consumer with utter interest as we go into the next few months. I think it's going to be fascinating Christmas time, and we're probably going to get a negative Christmas surprise, I think, as we get into next year. So
yes,
thank you very slightly. Thank you.
Thank you, Chris.
Thank you, Hardy. I really appreciate
everything you put out with great interest.
You're very kind. And well, it's been good. Brilliant. Thank you very much.